Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, all I ask is that you hit thumbs up and subscribe. Questions, comments, put those below. As always, I highly encourage you to go check out the Loonie Hour. It's our podcast there. We just released an episode called Who is Responsible for Canada's Housing Bubble. There's a link in the description below to go and listen to that podcast in Spotify and Apple Podcasts. FYI, I do release the podcast audio format several days before I post it here on YouTube. So if you want to go and check that out, it is now readily available. And of course, we encourage you to subscribe to the podcast channels as well. But basically, the premise of that podcast, I kind of want to elaborate on it in this week's video because it's really sparked on by a conversation or a speech that I believe was the deputy governor of the Bank of Canada. They also released a report basically about Canada's housing market, and they went on to say that the investor base in Canada in the Canadian housing market is growing. They're seeing more and more investors in the housing market, which is no surprise. And then they basically were saying, well, hey, this is actually creating larger risks to the housing market, right? More people accumulating real estate, some speculative activity. Should prices begin to drop, these people then, look to sell. There's these larger risks at play, and they were basically almost putting the blame sort of at the investor base. And I don't know as if they're somehow surprised. I mean, if we go back and look at Terranet data, this has been going on for some time. And we're going to get into that because I think it's a really important piece to really elaborate, because this is really the school of economics. Once you sort of learn about finance, markets, economics, governments and politicians, how they all work and intersect, you kind of realize and you kind of figure out that, to be honest, most of the stuff that you hear on the news and the media is largely incorrect or false. And not to say that it's fake news, but it's kind of misleading. And politicians or elected officials basically kind of say what they have to say in order to basically save face and be reelected. So I want to touch on that because, there's a prime example here. We've got the Bank of Canada saying that there's now growing risks in the housing market because of these investors coming in. But need I remind you to take you back to this clip of the Bank of Canada in July of 2020, July 2020, Tiff Macklin right here.
And so we have been unusually clear about the future path for interest rates. If you've got a mortgage or if you're considering to make a major purchase, or you're a business and you're considering making an investment, you can be confident that interest rates will be low for a long time. Low interest rates make spending and investment more affordable, and spending and investment will support the recovery. That would be our message to Canadians.
So remember, Tiff Macklin was begging. He was begging Canadians. In fact, I remember doing a video on this channel about that. I think the title might have been, Bank of Canada was begging people to go borrow money. You can go back and look it up. Basically what he was using was forward guidance. Listen, we're going to keep interest rates basically at zero until well into 2023. And if you're a business or you're looking to buy a big purchase, real estate, now's the time to go and do it. He wanted people to go out and borrow money. And so when you tell Canadians to do that, message received. If you look at residential mortgage credit growth, it's running at 10% year over year. It's the highest rate in over a decade. So, clearly Canadians took the cue, the signal, and started to borrow money for housing, right? So, we had mortgage rates drop down to in our 5-year fix. You're getting them at 1.5, 1.6%. Well below the cost of inflation. Canadians clearly borrowed that money. And so, lo and behold, since Tiff Macklin's speech, since July of 2020, national home prices since that speech are up 28%. And you can see here kind of, where he gave his speech versus, where national home prices are today. This is the fastest pace of home price acceleration ever on record. So I find it rather ironic that these guys will never ever come out and say, "Hey, oops, yeah, we did it. We might have overshot." It's just, there's some investors and we need to build more, right? So it certainly has nothing to do with the cost of money. And I put out this tweet the other day, but if we look at Vancouver, I guess, particularly in say Toronto, which is really the two major markets where most of price growth is, specifically here in Vancouver, over the last 5 years, let's see, what have we done? You've done a foreign buyers tax, a speculation tax, an empty homes tax. You've banned Airbnb. You've brought in a mortgage stress test. You've got new home completions at record highs. They've done everything. They've tried everything. They've brought in different taxes. They increased the property transfer tax. They brought in a school tax or luxury tax on the more expensive homes. And today, prices still continue to be high. The only thing these guys haven't tried is raising the cost of borrowing money. That's the only thing. So isn't that interesting that probably the most important thing to all of this, everyone's just buying a payment, is the only thing they haven't tried is raising the cost of money. And it's probably by design because, by doing so, it's probably the only thing that would actually work in obviously bringing house prices down and sucking the speculation out of the housing market. So it's all by design. It's all grandstanding. A lot of these taxes were brought in to have, very little teeth, and it's for a reason, right? I mean, governments are milking the housing market just as much as everybody else is. I mean, it's fantastic for tax revenues. But again, it's not something you're necessarily going to hear on the CBC network. But this is just the reality, right? I mean, if any sort of government or politician wanted to, I mean, there's so many ways that tomorrow you could probably incite a 10-15% correction in house price. It'd be very, very easy to do. First and foremost is you'd have to control, credit growth. You'd have to tell banks, hey, you can only issue, X number of loans per year. We're capping your loan growth. For number two, you could obviously hike interest rates, but we know what that would do. Number three, you could probably slow immigration. I mean, the Canadian government's got a target of 400,000 immigrants or population growth per year. I mean, who's to say that number shouldn't be 350? Now, I'm all for immigration, but you have to ask yourself, in a time, in a era where you're struggling with housing of record housing unaffordability, you're in a housing crisis. You have to wonder, is 400,000 the right target? Should you drop it to 340, 330, at least for a couple of years? Again, the only problem when you do that is you run into, so there's another Ponzi scheme that you have to keep going, and that's the Canada Pension Plan, which relies on, new workers and continuing to expand, the capital, the income sources that come into that sort of fund, right? I mean, you need more new contributors to pay out all the boomers that are now exiting the labor force. And so, and everybody says, then you look at GDP. Well, I mean, if you really look at real GDP per capita, there's been zero growth in Canada over the last 5 or 6 years. So the growth that you're seeing is actually just from increased immigration, right? So now again, coming full circle, that looks great for the government. I mean, if you're the Trudeau government, you want to get reelected, you certainly can't show a donut on the GDP growth. I mean, that ain't going to get you back into power. So what do is you obviously bring in a lot more people, and at least in nominal terms, your GDP goes up. You're able to obviously maintain and sustain the contributions and the returns in the Canada Pension Plan. You're able to obviously continue to support housing and housing growth and housing prices, right? I mean, everybody's well aware of how large a factor is of residential construction, right? I mean, you got to keep the shovels in the ground. One way to do that is to keep importing more and more people into the country. So like I said, at the end of the day, I mean, if governments were actually very keen to actually bring in levels of affordability. Very, very simple to do, but nobody actually has the stomach to do it, because at the end of the day, once you're in power, you want to stay in power. And it's the same thing, again, politics aside. I mean, I don't really care who you voted for, but if you look at the BC NDP here in BC, I mean, they were elected basically on housing, right? People were rightfully very disgusted with what was happening in the housing market in 2016, 15, 16, 17, and the BC government got in on the basis that, you know, they were going to bring back the housing market to the local people. And since they've come in, I mean, we've got record home price acceleration in the province of BC this year. And so this is a larger problem that really has a lot to do with politics. But the biggest thing ultimately is the cost of capital, right? So the Bank of Canada is again coming back here. Is they're kind of scratching their head and going, yeah, there's all these investors and we're creating these risks and lack of stability. I mean, go back, there's a speech in 2014 about Tiff Macklin talking about how unsustainable the Canadian housing market, how unsustainable the debt levels were. Well, it's like, guess what? This guy's now in power, and he juiced it. He juiced it in 2020. He told you to go out and borrow, and you did, through the loan growth and mortgage credit, and vice versa, that followed through into home prices. And so at the end of the day, that's going to continue. So you can bring in another tax, you can bring in, you can build a little bit more housing, but at the end of the day, you're going to continue to have more and more capital coming into the housing market. And the biggest factor for that comes down to the cost of money, i.e., you have a solvency problem in the global financial system, that, you know, the global financial system is levered 4-1. And in order to sustain 4-1 leverage, you have to basically continue to roll and refinance debt. And the only way to do that realistically is to suppress the level of interest rates. So you have to basically have nominal GDP and inflation running higher than your debt servicing costs, your interest payments. And so that's the only way to do it. And so with that, you've basically, in order to achieve that, you have to basically manipulate the bond market, which is essentially a pricing signal. So you distort the pricing signal in the bond market, i.e., the bond market, the yields on bonds aren't actually able to reflect the level of inflation in the overall economy. And so by doing that, you get a situation where you have today, right? You get a situation where inflation runs to 4.75%. And yields are 1%. It's you're looking at a negative 4% real rate on much of the government debt. And so in that era, in that dynamic where savers aren't able to generate return in safer instruments. So just imagine that you're maybe a more conservative investor. Maybe you're getting towards later stage in your life and you want to take some risk off the table. You want to pull out of some of the equity market, maybe divest some of your real estate holdings and put it into, say, a safer instrument, which typically would be GICs, government debt. But again, if you're earning a real negative return of 3-4% compounded annually over the next 10-15 years, that's a sure way to lose a lot of money. And so you're forcing, that's why you continue to see all-time new highs in housing, and all-time new highs in the equity market, and all-time new highs in the crypto market, because the capital is looking to go somewhere. The global bond market still is the largest financial market, is the largest asset market of all, and it is being basically destroyed and imploded. So, long story short, that's your economics lesson for the week. Fade, it's so easy once you guys figure it out. Hopefully this channel helps. Again, I'm certainly not perfect, but once you kind of figure it out, you can sit there with a straight face and you can watch the politicians and the central bankers you can see you literally sit there and it's just 30, 45 minutes of just lies that are coming out that aren't reality, right? I mean, the one thing I had to laugh this week, God bless, it's Turkey Week in the U.S. It was like Senator Elizabeth Warren coming out and saying that turkey prices are up because corporations were getting greedy and gouging people. Of course, it had nothing to do with the fact that you guys printed 30% of the 30% of all U.S. dollars in circulation have been printed over the last 18 months. It's got nothing to do with that. It's got nothing to do with harsh lockdowns where global supply chains have been decimated. Where the largest exporter in the world, China, is still running a COVID zero policy. COVID zero policy, zero COVID cases. But just remember, this is an airborne contagious virus that you are trying to go for zero cases in a population of 1 billion people. Doesn't make a whole lot of sense, but clearly not good for supply chains and not good for turkey prices. It has nothing to do with greedy corporations because they were out that same week talking about oil prices. It's the big oil companies that are gouging people, and that's the reason why your fuel prices at the pump are up. It has nothing to do with their policy measures which have stifled investment and discouraged investment in the oil field. But alas, I digress. That's a conversation for another time. As always, hope this helped. Love to hear your thoughts, as always, in the comments below. We'll see you next week.